My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Fed Chair Jerome Powell just delivered a message that markets were waiting for and investors should pay close attention. After 3 consecutive interest rate cuts, the Federal Reserve decided to hold rates steady at 3.5% to 3.75%. Markets barely reacted at first. The S&P 500 closed almost flat, but the real signal came during Jerome Powell's press conference. Powell said that the major risks facing the U.S. economy have diminished. That's a big statement. According to Powell, the upside risks to inflation and the downside risks to employment are now more balanced. In simple terms, the Fed no longer sees the economy at risk of overheating or slipping into recession at the same time, a scenario known as stagflation. Last year, tariffs, slowing job growth, and rising prices created serious concern, but Powell believes much of that pressure has eased. Let's break down why. First, the labor market. Powell noted that unemployment has stabilized around 4.4%, and while job growth has slowed, it's not collapsing. Immigration restrictions may have reduced both labor supply and demand, which helps explain weaker hiring numbers without signaling a recession. Second, inflation. Tariffs pushed goods inflation higher, but Powell said much of that impact has already been absorbed. He expects tariff-driven inflation to peak soon and then fade. Meanwhile, services inflation is cooling, which is exactly what the Fed wants to see. Third, consumer spending. Despite weak consumer confidence surveys, real spending data shows consumers are still spending. That supports the idea that the U.S. economy remains resilient. So why is this good news for investors? Markets prefer falling or stable interest rates, but only if the economy remains strong. Rate cuts caused by recession usually hurt stocks. Rate cuts during stability help stocks. Powell's message suggests the Fed believes the economy can keep growing without triggering runaway inflation. That's the ideal setup for equities, especially with AI-driven earnings growth supporting the market. But there's a warning investors shouldn't ignore. Powell has also said that stocks are expensive. The S&P 500 currently trades at about 22 times forward earnings, well above its long-term average of around 19. Historically, the market has only stayed above this valuation level during 2 major periods, the dot-com bubble and the COVID-era rally. Both were followed by sharp drawdowns. Data shows that when the S&P 500 trades above a forward PE of 22, returns over the next year average about 7%, lower than normal. Over 2 years, returns have historically averaged negative 6%. That doesn't guarantee a crash, but it does mean investors should expect volatility. Wall Street analysts still see upside. The median target for the S&P 500 implies about 10% gains by year-end 2026. But the risk of corrections or pullbacks is real. So, what's the takeaway? The Fed believes economic risks are under control. That's bullish. But valuations are stretched. That's a caution flag. For investors, this likely means selectivity matters more than ever. Strong fundamentals, pricing power, and long-term growth drivers like AI will matter far more than momentum alone. The market may keep rising, but the ride won't be smooth.